Stocks open but languish in listless trade amidst growing uncertainty over interest rates and growth. Metals and capital goods lead on the gains while FMCG drags today.
Reliance Jio hikes entry-level tariffs for new and post-paid plans that are still cheaper than Bharti's but introduces the cheapest available family plan. The move spooks the Bharti stock.
And a spokesperson for the Adani Group tells CNBC-TV18 that Ambuja Cements and ACC are owned by an SPV, special purpose vehicle controlled by Vinod Adani and belong to the Adani Group. The statement puts to rest all speculation on Vinod Adani's relationship with the Adani Group companies.
Crude prices slipped overnight on lingering concerns over the banking sector, troubles in the US. But an OPEC report forecasting demand recovery in China has sparked a bit of a recovery. Good afternoon. You're watching us here on Halftime Report. I'm Manglam Malu. With me, Sonia Shenoy. Sonia, first half of trade started with a bang and then went out on a whimper. We're down almost 100 points from the highs.
We are. And, you know, it just... that whole sell-on rally thesis is playing out yet again, right? I mean, so we lost quite a bit from the highs of trade. And even if you look at individual stocks, a lot of the stocks are under pressure right now. So some of the Adani Group stocks as well, not looking that great. You have HUL, Bharti Airtel, Nestle, Britannia. So the whole FMCG pack is under a bit of pressure too. Banks are sort of lagging behind yet again, Axis, Indices. I think all eyes will now be on their FOMC policy on the 22nd of March and on global news flow. So I think we'll be dancing to the global tunes. Up until then, the market is quite lackluster and not... The pullbacks are very, very shallow at the moment.
Indeed, they are very shallow. And then there has been this flight to defense as well. You spoke about a bunch of stocks which are not doing too well. Usually FMCG is the one that does well at a time, when there is some sort of uncertainty in the market. But this time around, that baton has been passed to the pharmaceutical pack. So we do have a bunch of pharmaceutical names which are actually doing well this morning. Divi's Labs is among the top gainers in the last half an hour or so. We have some big gains coming by in some other mid-cap pharmaceutical companies as well. Case in point, Torrent Pharma, Biocon has moved to the high point of trade, and a bunch of others too. But, few and far in between. We do have Ramkrishna Forgings, which is at a 52-week high, though.
It is. And, it's this is after Ramkrishna Forgings and Titagarh Wagons. They've emerged as the L1 bidder for a big railway ministry project. So the order is for manufacturing and supply of forged wheels under the Atmanirbhar Bharat scheme. Now, the total quantity of forged wheels that will be supplied is about 15.5 lakh wheels over 20 years. Now, I reached out to Ramkrishna Forgings and a couple of data points is what they gave me. There will be a total outlay and investment of 1,100 crores for this particular project, and it will be split equally between Titagarh Wagon and Ramkrishna Forgings. It will take about 2 to 2.5 years to set up this particular project, and initially they will need about 300 to 350 crores for the project as equity, and the balance will come in the form of low-cost debt from a European bank. That's what Ramkrishna Forgings told me. They also said that this is a guaranteed order of 80,000 wheels from the government, and the total revenue for this project, according to RK Forgings, is 2,200 to 2,300 crores per year. And they're putting up a capacity of 2 lakh wheels currently for this order. Now, why Ramkrishna Forgings is surging so much is because this is a new revenue stream for them altogether, right? From the government's end, getting this confirmed order of 80,000 wheels that they will be executing. So it's an immediate revenue potential of over 2,000 crores for them. And it's a brand new area that they can sort of channelize. They can focus more into more government orders. And we know how the government is getting into railways in a big way. In fact, we spoke to Umesh Chaudhary, who's the managing director of Titagarh Wagons as well, the other half of this JV. So let's listen in to what he had to say about this order.
The government is saying that we will assure you an assured offtake of 80,000 wheels for the next 20 years. You set up a plant. So your base capacity is filled up by us, and then you set up a plant wherein you can take care of the other private requirement and export resets. So this is the tender. The total value of the contract that the railways will place would be about 12,000-13,000 crores. But the total project would be much larger than that, maybe more than 2 times of that. This is, we bid in a consortium. It's about an equal consortium. First, the plant has to be completed in 24 months, similar to Vande Bharat that we spoke a few days ago. So I think a lot of things are going to happen in the next 24 months.
All right. He says a lot of things are going to happen in the next 24 months, but the last 12 months we've seen a big rise in the Titagarh stock, and not just Titagarh, a bunch of other railway stocks as well have benefited from increased government focus and ordering in this space itself. But Sona BLW, Sonia, you had told us after the block deal here at halftime itself that, while the block deal has taken place, it's not a particularly bad company, in fact, one of the best, and brokerages are now, reinforcing that.
So, after Blackstone exited, it's interesting, both CLSA as well as Jefferies have now, initiated reports on the stock. Jefferies, in fact, this morning initiated coverage on Sona BLW. They have a buy and they have a target price of 575. So they have a big upside. It's over a 40% upside compared to the current market price. Now, what they're saying is that Sona BLW is expanding its component portfolio in a big way. They are addressing this fast-growing electrification segment and the autonomous trends in the global auto space. They have a very large order book of over 23,800 crores, which is 9 times its FY23 revenue. So there's strong order visibility coming through, and Jefferies expects an over 30% growth in their revenues over FY23 to 26. The only problem is that the valuations after the steep run-up are looking quite rich. So the stock is now trading at over 38 times FY24 PE. So that is the problem. But there's the other, positive news flow where the stock will see a weight adjustment in the FTSE indices on the 17th of March. That's on Friday. So analysts are expecting a flow of $25 million across FTSE indices into the stock. And remember, just to put it into perspective, Blackstone has now exited completely. They've sold 20% of their stake. But even post that, the stock has seen a fair amount of rally. Today, it's consolidating a bit, but 2 positive brokerage reports coming in post Blackstone exiting.
Yes, and not falling today is as good as rising, given the sort of wobbliness we've seen in the market itself. Nifty virtually closer to the lower end of today's trading session. In fact, down over 100 points from the highs. Still sitting with a 60-point gain, but it has been eroded, significantly. The Sensex also up just about 1/3%. The mid-cap index marginally outperforming. So the market remains on our radar, on our focus area as well. So what we'll do is take a short break. On the other side, we'll get chatting with Nishant Sharma, who's the founder and MD, as well as the CIO at Kedara Capital. He'll join in to discuss his bets in such a volatile market.
Welcome back to Halftime Report on CNBC-TV18. So for now, the market is, it's given up a lot of its gains, but it's still holding on, batting for the bulls at the moment. Nifty holding above 17,100. But let's take a little bit of a breather from tracking the markets minute by minute and talk to someone in the private equity space. Nishant Sharma, the founder, MD and CIO at Kedara Capital, joins us now on the show to talk about what's happening with the PE space, what are the kind of investments they're looking at, and in this challenging market, what are the plans? Let me just tell you a little bit. Of course, Kedara needs no introduction, but as we know, it's an investment team that manages over $3.6 billion in terms of AUM, and they do have a lot of listed companies in their funds as well. Thanks a lot for joining in, Nishant. A pleasure to have you on the show. I was just going through some of the companies in your portfolio, and you do have a lot of listed entities. AU Small Finance Bank, there's an Avas Financers, there's a Vijaya Diagnostics, Spandana Spurti, so very interesting businesses. First, let's talk about the diagnostic space, because this is one space that has been under a lot of pressure, right? Because there's so much competition, there's pricing pressure. Right. And a stock like, say, Vijaya Diagnostics has not done anything for investors. In fact, earnings have also been weak. Do you still keep the faith in spaces like this that were at one point a darling of the market, but now have come off quite a bit?
First of all, thank you for having me. I really appreciate it. I think on your question, it's in some ways the normal cycle that industries and businesses go through. I think we feel very, confident in some of these businesses, like the diagnostic space in particular that you mentioned, where we had back Vijaya Diagnostics. It's a regional leader, a very high quality business run by, great set of founders. And, sometimes obviously because of a variety of reasons, especially, when interest rates increase and cost of capital changes, the risk perception of different, businesses and the discount rate changes. But fundamentally, in terms of the business, it continues to obviously be a strong business. And over a longer period of time, it'll continue to do well. I think there are times that you have to obviously deal with in the near term, but over a longer term horizon, which is what we do. We invest for the longer term. We invested in Vijaya with the 5-year sort of horizon, and in most other businesses with a similar view.
Right. Nishant, I'm also interested in a lot of the unlisted plays that you have, and these are brands and companies that you and I, witness on a daily basis. Something like Lenskart, you have investments in Purple, among others. Right. Or just wanted to understand, there's been talk of a funding winter in the unlisted startup space, so to say. How has business been for you there? We haven't seen a unicorn in India in the last couple of months as well, and that's a near 100% drop from the same time last year, so to say. And then there are new words. People are talking about zombiecons, which is basically unicorns which may be some dead zombies in the middle. How are you viewing that space?
Yeah, no, as I said earlier, I think it's a good question. I think the way we look at investing is really investing in businesses with a secular runway for growth, run by strong management teams, have moats which can sustain over a long period of time. So sometimes you have to deal with various changes.
Oops, okay, I think there's some issue with that video. We'll try and come back to you, Nishant, in a bit. We'll just fix that. But very interesting, actually, the funds, or rather the companies that Kedara has in its funds. So we were telling you about Vijaya Diagnostics. They continue to be very bullish on that story despite, so much pressure in that space. The other companies that they have, there's AU Small Finance Bank. Interestingly, there's Vandana Sphurti as well that they like. They have it in one of their funds, and they have something like a Vedant Fashions too. And, as Mangalam was pointing out, a lot of the unlisted companies is what they have as well in spaces which are growing, especially e-commerce. In one of their funds, they have Purple, which is, a competitor to, in the e-commerce space, a competitor to perhaps the Mintras of the world. And they also have Lenskart, Care Health, Ami Life Sciences. So very, very interesting businesses is what Kedara Capital has in its funds.
It'll be interesting to also find out about Lenskart itself, because I was reading this report which said that ADIA will buy $500 million worth stake in Lenskart, valuing that company at $4 billion. If that happens, then Nishant will perhaps be a very rich man for his fund. We will quiz him on that. What we'll do is actually just take a short break, come back, patch that connection back with Nishant, and continue our conversation. Welcome back. The Nifty holding up by just 45 points. When we started the show, it was up 60 points. In fact, from the highs, it's fallen much further, currently at the low point of trade for that index, and led lower by the Nifty Bank, which is now languishing below the 200-day moving average, which it broke below yesterday, broke above today, but that's proving to be a bit of a resistance. So we'll keep an eye out on that. But as we were trying to repatch that connection with Kedara Capital, Nishant Sharma is back with us. Nishant, you were talking about the unlisted space. Give us your views on that. And, we were also saying that ADIA is likely to invest about $500 million in Lenskart. Have you heard something of that? And if that happens, then you'll perhaps be a rich man.
I think we started talking about technology and Murphy's Law kicked in. But, as you can imagine, obviously can't talk about specifics. But the point I was making was that, when you have high quality businesses, then funding is available, right? I mean, the source of funding may vary. Sometimes it ends up being public markets, sometimes it ends up being private markets, could be sovereign wealth, could be other large long-term sources of capital. But for high quality businesses, the market's always open. And that's what we've seen when you have a long-term horizon, then irrespective of the challenges that the broader market sees, you always have a demand for businesses and management teams that are doing exceptionally well. And in Lenskart and Purple, we believe both those assets have strong runway for growth, great market position and scalable model, and run by terrific entrepreneurs.
Okay, but to be fair, right, Purple has not really grown as much as perhaps what was expected, and there's there's stiff competition, of course, in the form of Nykaa, but now there's Reliance Astera that's coming as well. Do you think it's going to get tougher for a company like Purple to sort of stand out amidst this clutter, and would you continue to keep the faith here as well?
Absolutely. So I think Purple's positioning is actually quite unique. I mean, it focuses a lot on own brands, and it focuses on more underserved tier 2, tier 3 markets. So relative to some of the names you mentioned, the focus is different, and it's creating a niche for itself. I think the growth here has been strong. Obviously, it's a private business, so can't specifically comment on numbers, but we feel quite happy with the way the business is positioned and growing. Obviously, like as I said, I think we look at businesses not for 1 or 2 quarters, but over much, much longer periods of time. And we see ourselves as a partner who can help management teams, really think through these and help realize the full potential. Because, we've invested in, obviously, as you said, Lenskart, Purple, Vishal, Manyavar, many retail businesses, and the ability to really bring that operating insights to bear across these different omni-channel retail businesses, and translating that even to some of our more recent healthcare services investments in Aliva, ASG, and Oasis, makes a big difference.
Right. Nishant, just a two-part question. One is that from last year to this year, have you seen a change in the way these unlisted companies are, focusing on profitability now more than growing their businesses? That's one. And secondly, you are a long-term investor. So have you written off gains for this year, at least in all your investments, and believe that maybe the returns will be back-ended in this year? Maybe debt would be, giving better returns for those who are looking at annual returns than equity and, the sub-equity categories?
So, most of our businesses continue to grow quite nicely, north of 20% growth on top line and, because of operating leverage higher on bottom line. And again, that's a choice of businesses and, how they're positioned with respect to their competitors in the industry. But the point you're making specifically, I think, is true more for the new age sort of startup universe, where probably when capital was available freely, there was focus on market share as opposed to profitability. Now that the capital in general is scarce, there's obviously focus on capital preservation and focusing more on profitability to enhance the runway for growth. So I'd say that's the theme in more new age businesses. For the businesses which, we typically have invested in more, mature businesses which are already quite profitable, cash flow generative. So there, the mantra has always been the same. That really hasn't changed. But yes, in new age businesses, I think we definitely see a lot more focus on profitability, which is the right thing. Ultimately, that's how a business is, becomes sustainable.
Okay. One final word on this entire microfinance space, right? Because you do have investments there in the form of names like Spandana Sphurti. And the growth has been good so far. For a company like Spandana, even, asset quality has been improving. But this space is also seeing a lot of competition right now. So how would companies like this be wading through that? And what kind of growth triggers do you see from here on?
Sure. I think, look, we have done a lot of lending investments, microfinance being one of them, affordable housing finance, like you mentioned earlier, in Aavas, AU Small Finance Bank, Veritas Finance, which is an MSME lender, recently Avance, which is an education lender. On microfinance specifically, to your question, I think we see a lot of opportunity because credit is still quite underpenetrated, especially to the underserved segments in the country. And that's something which we feel will continue to grow as we go from sort of, lower cycle borrowers to higher cycles. We expand into, more distributed sort of territories and so on. So I think here the biggest differentiator, to your point on competition, really lies in execution. So the team that drives the business really ends up being the biggest differentiator. And that's what we focus on when we back a business, and really building a high quality team, enhancing the team. And we strongly believe in the team, led by Shalabh in Spandana, that will continue to sort of gain share disproportionately. I think we focus in our lending businesses both on asset quality and on growth. And, that's important in specifically risk-oriented businesses like lending, where you have to balance the risk of collecting with the risk of growing. And that's where you calibrate growth in order to make sure that you're not being indiscriminate in any way.
All right, Nishant, thank you so much for joining in and giving us your views on not just your investments, but investments in general itself. Look forward to speaking to you more often as well. But let's move on to another important story coming in on Max Financial deal. Sources say that the promoter's stake sale has actually hit a roadblock. Nisha Poddar joins in with some exclusive details. Nisha.
Thanks for that. Yes, at least 3 sources with direct knowledge of this particular deal development have shared with CNBC-TV18 that this particular deal of promoters selling their stake in Max Financial Services, and promoters being Analjeet Singh and his family, as well as the group financial company. All those have about 11.45% stake in Max Financial Services. Earlier, we had reported that either a part or full stake is on the block. And what we gather now is that there is a roadblock in this particular transactions. So essentially, the private equity investors, some of them which are interested, and namely Bain as well as CVC and TA Associates amongst others, they would like a controlled transaction where the promoters exit from the company by selling 11.45% stake, and therefore that can trigger an open offer and they can get controlling stake over the company, which, remember, is a parent to Max Life Insurance, which is a great asset in which these private equity investors are interested in. So that's where the deal lies, that the promoter is looking at selling about 6 to 7% stake and retain the rest of the stake in order to monetize the upside on the stock price in the future, while the private equity investors who are looking at an investment want a clean, controlled deal and with an open offer where they become the promoters of the company. So that is the mismatch in the contours of this particular transaction that has hit a roadblock in terms of the deal negotiations, is what we gather from sources with direct knowledge. But we also know that Analjeet Singh has been winding up a lot of his investments and has been monetizing his stake in several companies, including Max Financial Services. And therefore, we had gathered that they had rolled out a process by hiring an investment bank which was engaging with some of the private equity players, namely Bain, CVC, TA Associates, amongst others. So at the moment, we can say that this particular deal has hit a roadblock. Whether any of the parties come back on the negotiating table and meets the other person's expectations needs to be seen, but very important information for the shareholders of Max Financial Services. And also remember, Axis Bank is a co-promoter in Max Life Insurance, of which Max Financial Services is a parent company.
All right, thanks a lot for that, Nisha. Thanks for giving us details on that. Let's slip into a quick break. On the other side, the market has given up quite a bit of its gains. Aditya Agarwala of Invest for Edu will be joining in with some trading strategies. Do stay tuned in.
Welcome back. You're watching us here on Halftime Report. Nifty up by about 50 odd points. Well, that's one way of looking at it. The other way of looking at it is that there was recovery from lows, but then that recovery has been extremely feeble. Looking at some of the cues coming in from the F&O space, you know, there was a recovery on the cards anyway because, one, the global markets bounced from oversold levels. Yesterday, the Nifty put-call ratio was 0.69. Usually when it goes below 7 or closer to 0.7, we do see a bit of a bounce back, and now it's back at around 0.75, so that's something that we'll have to monitor. The long exposure of the FIs was just about 13 odd %. So, you know, nearly 9 out of 10 FII positions are on the short side. And despite the sort of bounce...
Okay. Issue with your mic, so I'm
Alright,
just going to
try to
take over
fix that.
from there. But I can't promise to deliver on the F&O
Okay, I think I will
data,
just-
but you perhaps want to go ahead.
Yeah, has the mic fixed now? Yes, it has, perhaps. So resistance continues at higher levels is what I was saying. Because, you know, if you just take a look at the highs yesterday on the Nifty, 17,225, and the high on Nifty today is 17,211. So what does that tell you? That bears are backing the 17,200 mark to play out as a resistance, and that's why the 17,200 call is seeing a fair amount of writing. Those are yesterday and today's highs. 17,200 call added about 73 lakh shares in open interest for a 50 rupee premium. But bulls believe that levels closer to 17,000 and 17,050 could be their support zone, because the market will then go back to oversold levels. So 17,100 put is, you know, continuously seeing some writing. And also we have support coming in at closer to 17,000, because that will be the 10% correction from Nifty's all-time high. Remember, the Nifty bank bounced strongly from its 10% correction from all-time highs, but today is back below the 200-day moving average. So that's the other thing that we'll be watching out for. A bunch of resistance marks on the way up. Aditya Agarwala of Invest for Edu joins in. Aditya, your thoughts on levels on the important indices?
Hi, Maglam. Good afternoon. Thanks for having the show. There are resistances, to be honest, on the upside. 17,200, as you mentioned, is an intermediate hurdle at the moment, and 17,000 on the Nifty on the downside is a good support area. Mind you, after a massive fall, the first bounce is usually gets sold into. That is what we are witnessing in trade today. Yesterday, there were all indications of a bounce back. And in trade today, we had a perfect gap up open, and that got sold into. I wouldn't read too much into that intermediate or intraday selling that we are seeing for the day. In fact, I would use that as a buying opportunity. On the downside, as you mentioned, 17,000, 17,100 should act as a key support area. I believe keeping that as a stop loss, 17,000, I would look to go long on the Nifty. Look for at least targets of 17,150 to about 17,200 again on the upside. And I would be surprised if the coming week we see levels as high as 17,400, 500 as well, because I believe we are in for a good short covering rally on the market after a decent correction. And that should trickle same on the bank Nifty as well. On the downside, 39,000, 39,200 is a good strong support area. We are witnessing a tad bit of an underperformance in trade today, but the moment we cross 40,000 on the bank Nifty is where I believe we could see higher levels, at least northward of 41,000 on the bank Nifty as well. So all in all, I'm little bullish on the markets. Yes, there will be volatility, so it's not for the weak-hearted traders, but I believe we are in good for a short covering rally.
All right, so there's a short trading rally coming through, and yes, pullbacks can extend themselves, right, beyond a point. So tell us, if this pullback does extend as you believe, what are the stocks that you're looking at? What would you trade on the upside and what would you avoid?
Sonia, I would clearly avoid the IT pack at the moment and the FMCG. Clearly, there has been a bit of a selling pressure there, and I'm not too sure if it is bottomed out yet. There could be some more period of lull or maybe a sideways consolidation there. So I would avoid the IT and the FMCG pack. What is definitely looking strong is the energy and the oil and space gas. So BPCL is something which is looking very good on the charts. Yesterday in trade also it outperformed. Today we are seeing a good up move in BPCL. At current levels, I would look to initiate fresh longs there with a target of 345 on the upside. Put a stop loss at 323 on the downside, and BPCL should give you decent returns. The second stock on my radar is Asian Paints. Mind you, this is one stock which has clearly seen a downtick entire 2023 or maybe second half of 2022 as well. Now looks like it's poised for a good up move, at least 10 to 15% on the upside. So Asian Paints is looking good on charts. One can go initiate fresh longs here, look for a target of 2950 on the upside with the stop loss at 2800 on the downside.
All right, Aditya, thank you so much for joining in and giving us your views on the indices as well as individual stocks. Take a short break, come back. He spoke about crude prices, so let's talk about commodities itself. Manisha Gupta joins in with energy expert Narendra Taneja.
Welcome back to Halftime Report. Narendra Taneja is an energy expert and he joins us now on the channel to talk further about the crude oil prices there. Mr. Taneja, hi, good to have you. And after that 5% decline that we saw overnight for crude prices, there is some bit of a relief buying happening right now. Would you state it to the Chinese data that came in better than expectations, or do you think the weak US dollar and some final opportunity buying is what really seems to be supporting?
Well, actually, there was kind of huge anxiety in global oil markets following the collapse of the Silicon Valley, bank. And, some of the people, they concluded that probably that would harm the American economy further. And the American demand for oil may, go down. That was, I think, not a very well-studied reaction because, yes, they thought it's 28 to 2008 is might happen again, but that's not the case. That's not really the case. But at the same time, when you look at Chinese data, I mean, demand is likely to go up, if not at 800,000, barrels per day, but at least by 5. China has opened up, tourists started coming there and all that. But overall, my sense is the landscape is reasonably okay, and I expect the crude oil prices to continue to be in the range of about $80 to $90 per barrel. You might see at times, oil dipping to maybe even $72, $73 per barrel, or may even go beyond 90. But the average over the next 3 months is going to be like, between 80 to 90, unless, of course, the situation over Ukraine goes completely out of control, which doesn't look likely, at least at this stage.
Sure. Mr. Taneja, also, what's your sense on the macros? Because the markets are now anticipating a 25 basis point rate hike from US, 25 to 50 perhaps from ECB as well.
Well, good question. You see, thanks to India, China, and Turkey, that they've been importing Russian oil, and that is oil at a very, I wouldn't say cheap oil, but oil at a rate that, for instance, American economy, the Western economies like India are comfortable with. So markets have maintained that range. It's in the region of about $80, $85 and all that. So the result is the biggest beneficiary of low oil prices has been the American economy. And that's why, probably the response of the Fed going to be slightly different, because economy has done reasonably better. I mean, there were, of course, fears that American economy might slip into a deep recession, but that didn't happen thanks to low prices of crude oil. And who should they be thanking for low prices? India, China, and Turkey, mainly. Of course, other economies as well. So my sense is that probably will continue. America may keep talking about this thing, but America has seen it, Western economy have seen it, that low prices are actually helping them to tackle the deal with, recession and so. I don't expect any deep recession. I think economy will continue to recover. And the Fed has done what Fed has done, and they might continue to do that. But the biggest help that's being provided is by cheap oil, or oil at least at the rate of $80 per barrel. And for that, they should be thankful to India, China, Turkey, and among other importers.
All right. I'll wind up the conversation with one final question. And do you think the dependence on Chinese demand coming back is way too strong in all the forecasts that we see in crude prices?
Well, you see, China is, the second biggest consumer of oil after the United States. And all indications are that Chinese demand is going to go up. But I don't really think there's going to make any huge difference in terms of prices being pushed up further and all that, because the market is well adjusted. There's enough oil available. They were, of course, concerned the Russian oil might kind of disappear from the market. That has not happened. Sanctions may remain, but Russian oil will continue to flow because that's what America wants. That's what the Western economy wants for their own self-interest.
Absolutely. Mr. Taneja, as always, thank you so much for joining us and talking to us about crude oil, the opinion, analysis, and of course, the price view. But with that, let's slip into a short break. We will get you more on markets and stock-specific action on the other side.
Welcome back to Halftime Report on CNBC TV18. Just to wind up how the day has been so far, in case you joined in late, it started off to be a really good day, but then as you can see, the sell-on rally trade played out, and now the Nifty has given up a lot of its gains. So the high of the day that we saw in the early morning, the first take was around 17,211, and now we're barely hanging above the 17,000 mark by the skin of its teeth. What's batting for the bulls this afternoon? Just pull up the contribution plate. There are a lot of consumption names. Asian Paints is actually a top Nifty gainer this afternoon, up almost 3.5%. In some fashion, you have the steel stock. Tata Steel has come back. Kotak Mahindra Bank, L&T, Infosys are a couple of other names that have done quite well. But what's dragging the market's feet is Nestle, HUL, Bharti, Britannia. So, you have on both sides of the line, you have a lot of stocks from the consumption space and the banking space. So banks like Axis, IndusInd Bank are also under pressure. But with that, we will wind down the day's trading action on Halftime Report. Thanks a lot, but don't go anywhere. Business Lunch will take all the action ahead.